Welcome everyone to our webinar on intelligent disruption, fintech, and the private equity model. My name is George Danner. I will be the moderator for this webinar. It is 30 minutes in length, and we will have 10 minutes reserved for your questions that we will take at the end. This is an exciting time in the private equity asset class, and there are lots of disruptions happening already. This is a forum where we're going to talk a lot more about that. We are in an era of fundamental change, and it's brought about by this sort of perfect storm of technology, of performance demands, and of unprecedented market access. And our responses as an industry is what we'll talk about today. What kinds of innovations are on the horizon for us, and how we can become our own source of disruption to the standing order. Again, my name is George Danner. I'm president of a company called Business Laboratory, and we're a company that implements artificial intelligence technology and automation for all kinds of businesses. Joining me today, I have an outstanding panel for you. Nils Schroder is Chief Investment Officer at Schroder Adveq, which is an active investor in disruption through its venture capital investments. Nils is also heading Schroder Adveq's data science activities through an entity called Schroder Adveq Labs. I also have Roberto Bonanzinga. He is the founder and investment partner at Inreach Ventures, the artificial intelligence investment firm focused on early stage European startups. So we've assembled a really fantastic panel, the right people to talk about this kind of disruption. And here's where we will start the conversation on innovation and disruption. This is, if you will, a sneak preview on the disruption and innovation panel session that we will be doing at the Super Return Conference in Berlin on February 26th during that summit day. So let me open the webinar with some questions of my fellow panel members. I'll first start with just kind of an overview question, which is, gentlemen, does the private equity model even need disruption? Many firms report to me that they're doing quite fine and that the market is quite fine. Why do we need this disruption? I'll start with you, Nils.
Yeah, hi George, hi everyone, happy to be here. I'm not so sure if you could say that the private equity needs it for several reasons. One reason is that the model is working very well and has worked well now for decades, and all surveys among investors show that investors are very, very happy with their private equity investments. So from that perspective, you might say the private equity model doesn't need it. If you look at disruption in general, then you also see that in most cases the disruption does not come because clients push for it. Often when disruptions comes, it's the opposite, that clients first say, what is this? Do I really need it? And then it gradually gains adoption, and in many cases then very widespread adoption. So for disruption, if you look at the history of disruption, it's often driven by innovation and by technology, and then adoption comes as a second step.
Okay, very good. Roberto, do you have any thoughts on this matter about the need for disruption?
Yeah, I mean, first of all, I want to echo Nils' point. First of all, thanks a lot for having me on the panel, and thanks to you specifically for coordinating it, for the people that are listening to us. I don't think private equity is different than any industry. And if you ask any industry or any company in any industry, nobody will tell you they need a disruption. And actually, I'm just thinking about an industry that I knew quite well. I've been a venture capitalist now for 10 years, but before that, I spent lots of time as an operator in the telecom space. And I remember a few years ago, talking to the senior management at Vodafone, and, they had this incredible revenue stream based on SMS. And, it's not like you were asking Vittorio Colau, Vittorio, do you think you need a disruption on SMS? And they thought SMS was going to be there forever. And then there was this company called WhatsApp, and the whole market completely changed. That revenue stream evaporized in the hands of all the mobile operators. So I think I'm a bit in agreement with Nils. It's not the question if the private equity needs disruption. The question is, are there innovation waves that can be captured that would imply an evolution of the private equity model, or of the creation of a new way how it's possible to invest in private companies. And, been spending almost all my life in building innovation and investing in innovation, I will find anti-intuitive to believe everything innovates, but the way how we invest in private companies does not innovate. Usually, that's not what history would suggest.
Well, let's keep on that innovation theme there. I'll ask each of you if you see a particular aspect of how private equity asset class works, from deal sourcing, deal qualification, underwriting, reporting, compliance, risk. Are any of these areas in particular the ripest candidates for the kind of innovation that you're describing? This time, Roberto, I'll start with you.
Yeah, I think the answer, to this question is, I'm a big believer that we are going to see innovation across all the different steps of the typical value chain of a private equity or venture capital firm. And the single, let me say, component into all of this will be the use of software. And I think we are at the very beginning about leveraging the potentials of software in the way how such firms operate. Because let's be honest, these firms, they have been seen a lot, typically, as a professional services organizations. The fact of very, more based on the people, and technology has been seen almost as a collateral. And the question as you do, okay, but can software really change the way our firm operates? And I believe so, and I believe it's possible for that to happen across all the different pieces. It goes from the deal sourcing to the portfolio management aspects to up to the exits. And I think what is interesting is nowadays there have been some key evolution of some technology pillars that are making all of this possible, while maybe somewhere in the past was a bit more difficult to conceive. Nowadays, there are some key trends on the technology side and not specifically imply on the software side of things. Two key technology come to mind, the use of big data, the use of machine learning / artificial intelligence, that, in the past were extremely prohibitive, or A, because they were not feasible, B, because they were extremely expensive to adopt. And now, all suddenly, all these options are open into any potential, private equity firm or any potential venture capital in the world. Now the question is, can we really take advantage of it, and how? And I think that is something I really look forward to discuss in the following pieces of the panel.
Yes, indeed. Nils, your thoughts on areas that are particularly ripe for these kinds of innovations that we've been talking about?
Yeah, I believe there are many opportunities for innovation and for very material innovation. Then for each of those, one question is, will it be disruption in the proper sense of the word, or will it be a significant improvement of existing products and business models? And it could be one or the other, it could be both in some cases. And there is a big potential for innovation and for change if you have a new enabling technology, which we clearly have. And Roberto mentioned the most important ones, like big data, machine learning, and blockchain, also potentially in the long run. And at the same time, if you have a situation where things, even though everybody is happy, could be done in a much better way in the future. So if you go through the different parts of the private equity business model, then on the investment management side, we are all in the data analysis, data processing business. And of course, that is an area where if you have more data and collect it more systematically and apply new analytic technology and new software to it, then the data analysis and the decision making can be significantly improved. And that is clearly one area. If you look at how private equity investments are structured and also how they are transferred from one investor to the other, then this is probably not the most efficient way it can be done, and there might be better ways to do it in the future, and there's room for innovation. If you look at the interaction with LPs, then it's clear that LPs want more data, more look-through transparency. They're getting a lot of that already, but much more could be done potentially. If you look at how fund administration works in our industry, where it can be pretty complex and complicated, especially in Europe, and that's mostly due to regulation, then maybe in the future one day there's a better way to do it. If you look at reporting, the way reporting is being done in the industry, where in many cases PDF reports are being sent and investors type in the data again and again in parallel, that's clearly not the best way to do it. So potential there. And then even though everybody is very happy with the industry and especially with the performance and the net performance, then of course it's clear that in private equity fees are higher than in other asset classes. And if there's anything to be done there to reduce fees in the long term, then that's clearly something that investors are also interested in. So there are many areas where improvement is possible. There's new enabling technology, and these together will lead to significant innovation.
Well, thank you, Nils. I agree. And my perspective, coming from many, many years outside of the private equity asset class and sort of coming into this relatively recently, I'm seeing lots of conversations in the deal origination space. There was a recent article about a company on the West Coast U.S. called Hone Capital that's using artificial intelligence for deal sourcing and origination and filtering. I've been exposed to companies that are looking at the underwriting process and expanding leveraging human activity in the underwriting process with algorithms so that the same people who are handling X deals today can handle 10X deals in the future. So underwriting certainly is one that's getting some attention. And Nils, you mentioned it as well, which is the reporting side. I'll have to say very honestly, I was somewhat shocked when I saw how reporting, particularly between the LP and the GP, typically happens. It was very manual. It was slow. It was cumbersome, labor intensive, prone to error. It was as if I had woken up in 1994 all of a sudden, having looked at this interface between an LP and a GP, and I'm sure the one that I looked at was not alone, was not an isolated incident. So certainly reporting is one area just very clearly could use some innovation, could be brought up to a modern standard just right there. So just in the space of our short conversation, we've identified, I think, clearly some important core areas to the way a private equity firm operates that are right for these kinds of innovations. So let's follow that thread even further. Roberto, you and Nils both talked about a little bit about the LPs and their role in all of this. I'm wondering if the LPs themselves are looking to drive innovations in GPs, or could the opposite be true, that LPs, because of their compensation models or appetite for risk, aren't stepping out there and investing in firms that are trying to be disruptive? Nils, I'll start with you. Is there a role for LPs, has there been a role for LPs in pushing these innovations downward, if you will?
Well, I'm not sure if they are pushing it, but I believe they are very interested in it. And if there's something that makes sense and is good, I believe they are open to it and they are rewarding it. So in that sense, I believe for all these topics, there's a lot of support from the LPs overall.
Great. And Roberto, do you have any thoughts on the role of LPs here in the space of disruption and innovation?
Yeah, I think similarly to what Nils said, I'm not sure again that they're looking for innovation for the sake of innovation, but I'm sure they're looking in understanding how innovation can help in two areas, right? A couple of areas, I would say, at least. One is, can innovation help the private equity venture firms in which they invest to actually perform better? And I'm sure they are super interested on that topic. The second question is, I'm sure they're also extremely interested in understanding if technology can help to increase the operational leverage, if you wish, of the firms in which they decide to invest. You mentioned, some efficiency that is possible to create. Some of those efficiencies, for instance, in Europe are extremely significant because of the geographic fragmentation. And I think, so I'm less convinced that they care of technology for the sake of it, but I think they are super sensitive to figure out if technology is going to be a driver of value creation for them. And, these obviously open a very interesting question. And the question opens up is, okay, but how do I value or assess firms, private equity firms or venture capital firms that actually really using technology in a different way and they are innovative? Because as everything, innovation, it's not something that you see from day zero, right? You see it when you see the results. So I think one of the dilemma now that some LPs might have is, okay, what do? We stay here and watch until we don't see somebody adopting innovation, showing incredible results that are better than average, and then we go and we invest. Or, we start making some bets in some of these innovative models. And it's very easy to identify innovation once has been happening. As going back to the example I was mentioning today, everybody would agree that WhatsApp is a great utility service, but there were very few people that were capable to invest in WhatsApp because very few people saw the potential of WhatsApp at the moment in which WhatsApp started. And I think that element of discoverability, every time there is discontinuity, it's very hard to do. And if I would be an LP, I'm sure many of them, they're asking themselves the question is, what do we do?
Understood. Well, thank you, Roberto. And I completely agree with your comment there about technology is important, but it's not the only ingredient here. But for the moment, let's dive into the technology side of this, particularly for our audience members here. And I think it's important for us to distinguish between sort of the two different flavors of technology that we're talking about. There's traditional technology, the traditional IT domain, digitalization domain, and then there's some of these new technologies that we're talking about in machine learning and artificial intelligence and even blockchain. So let's tackle the technology side. I'll ask each of you, do you have particular technologies that you believe are going to be some of the most important, let's say in the list of the top 5, that private equity firms should be thinking about now and will likely be important as we go down the road? So Roberto, I'll start with you. Any technologies that you're watching very carefully that you believe have a bearing on the performance and success of the private equity asset class moving forward?
George, because also the job I do, that is, for the last 10 years, I've been only investing in technology companies. I just really don't like the approach. I mean, I don't think the question is about what are the technologies. I think the question is what are the use cases that are maybe the priority use cases in private equity venture firm. And then what are the technologies that support those use cases? To be honest, I think it's a secondary issue. Now, there are some new use cases that are possible thanks to the emerging of new technologies. But I really encourage everybody to stop thinking, about technologies and be super focused about the use cases. Just yesterday I met a guy that for 2 hours was telling me about how fantastic it was the blockchain, that obviously is a fantastic technology, but the use case he was describing didn't make any sense. So going back to the key question, what are the use cases? I think some of them have been already alluded to. I think a very important use case has to do with the element of discovery. And if you wish, deal origination or deal sourcing. And for that specific use cases, that use case, there are some key technology underneath it that are significant. And obviously the two ones that I already mentioned. One is the big data capability, because today there are lots of data available that in the past they were not available, that can be aggregated and can develop extremely interesting signals to give you a sense about the potential private investment opportunities even before you actually potentially meet with the entrepreneurs. And the second part that is very linked to this is, machine learning, because machine learning is just an amazing tool to help in filtering these opportunities. So I think there is definitely a great use case in this discovery. I think there is a great use case in, let me call it portfolio management, where there the technology, if you wish, are mostly in the area of workflow. But I do believe that in that area, you can easily reach, we are seeing this today, 10x, operational leverage compared to a traditional way to do things, the moment in which you start to redesign your processes, taking advantage of technology. And I think, a very interesting, last and not least, use case into all of that actually has to do with exit analysis, because even there, I think there is a lot that can be done with machine learning, with data, with analysis of what has been happening there that can give extremely interesting patterns. I think the whole world of M&A will be completely, as a use case, will be under a significant level of transformation through some of these technologies. So I really encourage everybody to think more about the use cases more than technology. As last and not least, obviously blockchain is a fantastic, technology, but I would say more important the use case of relationship with LPs might not only be limited to reporting, but potentially could be limited, also to collection of cash and management of that cash distributions. And yes, in that type of use case, maybe blockchain would be very interesting. So long story short, I'm all about use cases more than technology. I feel technology should be only supporting use cases, and I encourage everybody to think about their roadmap, not thinking about the technology that they want to put into their firms, but thinking about the use cases that they want to attack.
Well, that's a point well taken, Roberto, that technology alone is not the answer here and is not the one force that's going to cause any kind of innovative model, any kind of disruptive model. It's the use case that surrounds that technology that is the thing that really matters. In my book that I wrote 2 years ago, Profit from Science, I took great pains to emphasize this point about working backwards from the business challenge and then mapping that to the art of the possible, which is rather astounding these days with some of the technologies that you outlined there, Roberto, with machine learning and with blockchain and with other forms of artificial intelligence like narrative science. Nils, do you have a point of view on the technology side of this whole disruption space?
Yes, of course, I agree with the statements that both of you made, that the use cases are important and an important starting point when looking at where innovation and improvements can be made. I believe it's also helpful to look at the technology to see what is new on the technology side and what can be applied to existing use cases where in the past there wasn't the right technology available. So I believe you can approach the topic from both sides, but ultimately both elements are important. We spoke already a lot about data analysis and where new technology matters there, especially machine learning. But I would also say also many much more traditional statistical methods, they are very relevant for the private equity industry, which overall haven't been used a lot, but now as there's much more data available, also some more classic statistical methods can lead to really interesting insights, and some of this can be transformed into software so that you have some automated analysis. Technology is always best where you have most data, and if you look at the value chain in private equity investment management, then where you have a lot of data is on the sourcing side. So we mentioned that several times, that for sourcing and deal flow generation and screening of deal flow, that's an area where technology can have a big impact. Another area where it can also have a big impact is on the monitoring side, where you have also a lot of information about existing investments. These are two areas on the data analysis side. You see also some established firms working in that direction, as we do at Schroder Adveq with our Schroder Adveq Labs initiative now for several years, and as Roberto is doing with his firm, who's very much focused on technology for the investments he does. But then there are also some use cases outside of investment management and outside of data analysis, some of which are also being enabled by new technologies. Just to mention two, one is crowdfunding, which is an innovative topic that is likely to grow in importance, which is enabled by technology. You could argue more standard technology, like the crowdfunding marketplace, but that's still relevant and can have an impact. And then if you look at blockchain, then in the long term, there could be an innovative use of blockchain if it would help to change how investments are structured and transferred. If you look at the initial coin offerings that have been done by startups, they've raised more than $3 billion through initial coin offerings already. Much of that is happening in somewhat in a regulatory gray zone, and not all of that will lead to good developments, but in the long term, there could be a way to structure investments differently through a decentralized ledger based on blockchain technology, even though this might take some time to get there, and there are many uncertainties if and how we get there, but this is clearly an area that is worth following.
Excellent. Thank you, Nils. We have a couple of minutes before we're going to be starting the Q&A session, so I would encourage you out there in the audience to go ahead and send in your questions, and we'll take them here in just a few minutes' time. So lastly, let me cover a topic that really deserves a lot more airtime, but we're going to cover it briefly, and it's the topic of automation. If you go outside of private equity and you look at every other industry out there in the general economy, what you're finding is time and time again, higher degrees of automation than we've ever seen before. Fewer humans doing the work inside these organizations to make the same level of output. So automation is finding its way into literally every industry in the economy. It seems that's slower to adopt in private equity. As I have spoken to people in the industry, they believe it's because of the human experience and knowledge absolutely required, the art that's required to manage a private equity firm these days. So is that impossible to automate? It seems like there needs to be some way to capture the experience and knowledge of talented people inside private equity firms before it naturally leaves. What level of automation do you see coming in the private equity industry over the next decade, if any at all? And Nils, this time I will start with you.
Yeah, I believe that if you look at the history of private equity, then a lot of automation has already happened, which is more based on the very traditional IT that most firms use, at least most of the larger firms use. Of course, there are still many areas where more can be done. The biggest impact will come from applying new technology and from applying statistical methods, software engineering, and this also includes in-house development, where firms develop software for their own purposes, tailor-made for their investment philosophy, strategy, and process. And I believe the general trend that you will see, which for some firms has already started, is that the mix of skills in the team will change initially slowly, and I believe this is something that will accelerate, where you will see also in private equity firms that the teams will include, in some cases already do include, data scientists or scientists more in general who apply a more scientific approach to how investments are being done, and also software engineers. So with the change in the skill setup of the teams, I believe you will also see additional, not only automation, but also new applications of technologies. It's not all about automation, it's also about doing new things in areas where this hasn't been done before.
Outstanding. Roberto, what's your take on the extent of automation that you see coming through to the private equity industry over the next decade?
I keep short because I want to make sure we leave time for the questions. But, I would say I think it's going to be very significant. And to me, the most intriguing question associated with this is what does it mean in terms of the evolution of the organizations? What is the private equity firm or venture capital firm of the future? What do they need to look like organizationally wise? In terms of company culture, how do they need to evolve and change? And I think what we are going to see is going to be something that is fairly dramatic, because today we value private equity firm, venture capital firm based on track records, because we think that is the only way how you can have a proxy of future returns. And I will make the argument that actually for the future, if you want to have a sense of future requirements, you need to look in a very completely different way. If there is not a partner in the firm that is a technology partner, I think it's difficult to predict very good positive, very good future returns. So the way how the organization are going to evolve, the organizational culture associated with that is going to evolve, the way how we are going to assess the private equity firms or the venture capital firms of the future, I think is going to be very different.
Mm-hmm. Okay, excellent. Thank you, Roberto. And I agree with you. I think you're going to see a realignment of talent in private equity much more aligned to a technology capability rather than a financial capability, or a blending of the two. Well, so now let's start the Q&A side of this. Thank you, my panel members, for your earlier remarks. Let's take some questions from the audience. We're already seeing a number of these questions come through. So let me start with the first question, and that is, what do you think about algorithm and API access? API, automatic programming interface, so a programmatic access to public and private data to scout and evaluate SMEs, small to medium enterprises. I'm assuming that that's what the acronym is for. So I'll start with you, Roberto, your answer to that question. Algorithm and API access to public and private data to scout SMEs.
So, I see that as an extremely interesting trend. I am a huge believer of that. We actually here use that type of approach a lot. I think what is the most interesting aspect is we should think about when companies get started or when companies grow, think about how many different traces they leave on the internet. And all those traces are at the end data points. And those data points, think about them as dots. I think how much information you could, exploit the moment in which you connect those dots. If you connect those dots because you use private information, because you use public APIs, whatever, and what is the most interesting thing is we are going to see more and more dots, so the possibility to connect those dots is just exponentially growing. We see it if you look in the last 10 years, and we are so excited when we look about what will happen in the next 10 years. the key to everything is data, and we live data. We create data for everything we do, and companies create tons of data. We're just not used to see the world like that.
I agree. I've had a chance to study the history behind a number of innovations and essentially inflection points in given industries by virtue of my work on the books that I write. And it's notable that usually those innovations happen when the friction of connections is taken away. I think we can take away a lot of the friction in our ability to access this data, Roberto, that you're talking about, when we allow programmatic access to a variety of these data sources. Those data sources have existed for a long time, but if we grease the skids of the last mile to the application, I think we're going to enable an explosion of innovations. So with that,
George,
please, yes.
If I can
jump in, so okay, go ahead, Roberto.
The biggest data source is the internet itself.
Right. I've heard this term, using the internet as my hard drive, and which implies that everything on the internet has a nice, clean programmatic access that we can get to literally every aspect of the internet very easily through the algorithms that we build. Nils, you had something to say.
Yeah, so what I would like to add here is I believe we all agree that what we just discussed, that there are interfaces for the data and also interfaces for algorithms that can be used in a very decentralized way. That is the long-term vision. And in the very long term, I believe that's where also the private equity industry will move towards. What we need to keep in mind is that currently we are still at a very early stage of the evolution towards more data and applying more data science. And we spoke about applying machine learning and statistical methods, but a big challenge today is to aggregate and combine the existing data, and also in some cases to just clean it, which sounds simple, but it's not simple. So I believe there will be certain stages of how the industry will develop. I believe initially some of the larger providers will do a lot of the aggregation and data preparation in-house. In some cases, that's then proprietary. I believe there are already external data providers who do part of that. And then over time, I believe we will probably move to a more open architecture with also more standardized interfaces for data. But I believe that's more the longer-term vision.
Well, thank you, Nils and Roberto, weighing in on that question. I think we have time for one more question that we'll get to rather quickly. And of course, it's a question that involves the B word that we've used already, blockchain. So here's the question. What about blockchain technology for PE to deliver data room and manage the deal, workflow data, and the exit on platform? Nils, I'll start with you. Your thoughts on that question.
Yeah, so there are use cases where you can use blockchain information and the related technology to secure data and make it unchangeable. It's still to be seen to what degree that use case will be relevant. What needs to be kept in mind for everything around blockchain, and there's currently a lot of excitement and also some overexcitement around blockchain, is that there are always alternative ways how you can do it without a blockchain. And I believe use case by use case, it needs to be seen, is the blockchain really the superior technology compared to the alternatives? And I believe the jury is still out there. That needs to be seen.
I agree. I think it's a very useful technology, but there are certain criteria that need to be applied. It fits a certain very specific class of problems. Roberto, any thoughts on blockchain technology for the things they mentioned, data room, manage the deal workflow, data, and the exit?
I think, again, it's all about the specific use cases. Obviously, the key opportunity that the blockchain gives is the sense of a distributed place where you can put information that de facto, nobody really owns it. So I'm not sure for the data room itself if it's the killer application. But if you want to do something which de facto you don't want to have a central authority to own access, then the blockchain can be very helpful. But I'm not convinced that data room by themselves are the best use case for it. I think in terms of exit, well, Nils obviously already referred to that, referring to the world of ICOs that, on one side, they can be sometimes seen as a utility token and sometimes a bit, or, in some jurisdiction, they've been seen as a way how to inject funding into companies. And, obviously, because it's always possible to do secondary of those tokens, they could potentially determine some exits, but I think the issues are going to be a lot in terms of, regulations and the way how all of this can be regulated. I think the blockchain itself as a technology is one of the most interesting things that has been emerging in the last few years, but I'm not sure we know exactly yet how to take advantage of it. And I think, unfortunately, there is a lot of people that are really taking advantage of the hype that generates more noise, and it doesn't help.
Well, gentlemen, I want to thank you both. We've come to the conclusion of our webinar. This has been an outstanding conversation, but at the same time, I feel like we've just scratched the surface. We could probably go on for a long time talking about some of these topics, and of course, we'll expand on this more on February 26th in our panel session at 16:30 in the afternoon in Berlin. We will expand on some of these topics and cover some other related areas. I'd like to remind our audience, if you would, to please stay on for just another minute or two, and please fill out the survey on the webinar. That feedback is going to help us a great deal. Again, thank you to my two panel members. Thank you, Nils. Thank you, Roberto. Excellent discussion, great content here, and I look forward to conducting the panel with you on February 26th.